The number hitting your bank account may not be the Social Security benefit you are actually entitled to receive, and the most dangerous mistake is assuming that a government payment must be correct simply because it arrived on time. A retiree can lose $40, $100, or several $100s every month without seeing one dramatic warning. The deposit still appears, the bills still get paid. The loss hides inside an earnings record, a claiming date, a Medicare charge, a tax decision, a spouse's record, or a repayment notice that most people read too quickly. In 2026, the average retired worker benefit rose with a 2.8% cost of living adjustment, yet the standard Medicare Part B premium also rose to $290 a month. That means a person can hear that benefits increased and still look at the bank account and wonder why the increase feels smaller than expected. Pay close attention to this, because the secret to protecting yourself is not a special investment, and it is not a favor from an employee. It is learning to separate the amount Social Security says you earned from the amount that is actually deposited, then checking every reason for the difference. Stay with me through the end, because I am going to show you the quiet places where benefit amounts change and the exact documents that can reveal whether your payment deserves a second look. I have spent decades watching ordinary Americans trust numbers that were never explained to them. Most of these people did nothing reckless. They worked, paid payroll taxes, raised families, saved what they could, and believed that when retirement arrived, the system would calculate the rest. That belief is understandable, but it is incomplete. Social Security is built on records. Records are built from wage reports, self-employment tax returns, dates, marital history, Medicare enrollment, and notices entered into large government systems. When those records are complete, the formula can work exactly as designed. When one part is missing, outdated, misunderstood, or never claimed, the result can be lower than the person expected. This is not automatic in the way most people imagine. The deposit is automatic after approval. The protection is not. Here is what almost nobody understands. There are at least 3 different numbers hiding behind one monthly deposit. There is the benefit before deductions. There is the amount after Medicare, tax withholding, or recovery of an overpayment. Then, there is the amount that your bank makes available in your account. Those numbers may be identical for one person and very different for another. A retiree may say, "Social Security cut my check," when the basic benefit did not change at all. Medicare may have changed. An income-related surcharge may have been added. Federal tax withholding may have started. A prior overpayment may be collected. Or a deposit may be delayed because direct deposit information changed. Unless you compare the official benefit notice with the bank deposit, you are looking at only the last number in the chain. This is happening quietly because the system is not designed as one simple retirement check. Social Security, Medicare, the Internal Revenue Service, employers, payroll companies, banks, and the Treasury all hold different pieces of the picture. Your employer reports wages. The IRS receives tax information. Social Security builds an earnings history. Medicare premiums can be based on tax return income from 2 years earlier. The Treasury sends federal payments. Your bank receives the electronic deposit and applies normal account controls. None of this means someone is sitting in a room personally watching your grocery purchases. It means software moves information between systems, compares names, numbers, dates, earnings, and account instructions, and acts according to rules. The mechanism is invisible because most of it happens before you wake up and check your balance. People often blame the Federal Reserve when their retirement income feels weaker. The Federal Reserve can influence interest rates throughout the economy. Those rates affect mortgages, credit cards, savings accounts, certificates of deposit, and the cost of borrowing. But the annual Social Security cost of living adjustment is not set by the Federal Reserve and is not based on your personal bills. It follows a specific inflation measure called the Consumer Price Index for urban wage earners and clerical workers. That distinction matters. Your rent may rise 8%. Your homeowner's insurance may rise 12%. Your prescription may double. Yet the national formula can produce a much smaller adjustment. The formula may be operating correctly while your household still loses purchasing power. That is why checking the benefit amount is not the same as asking whether the amount feels sufficient. One question is about accuracy. The other is about whether inflation in your life matches inflation in the formula. The same confusion happens with credit scores. Your credit score does not calculate your Social Security retirement benefit. A low score cannot legally reduce the retirement benefit you earned from covered work. A missed credit card payment does not erase your work history, but debt can still consume the payment after it reaches you. High interest can turn a $5,000 balance into years of minimum payments. A bank may use automated systems and artificial intelligence to detect unusual account activity, prevent fraud, or review credit risk. But those bank models do not replace Social Security's legal benefit formula. This distinction is protective. It keeps you from chasing the wrong problem. If the Social Security amount is wrong, you look at Social Security records and notices. If the bank balance is shrinking because of automatic payments, fees, or debt interest, you look at the bank statement. If Medicare is taking more, you look at the Medicare premium decision. If federal taxes are involved, you look at the tax return and Form SSA 1099. One payment can touch 4 systems, and each system has a different correction process. Now think about a retired machinist named Robert. He is 68, lives in Ohio, and sees a deposit of $1,246. He remembers a letter showing a larger amount, but he assumes the difference is normal. He does not open his online Social Security account. He does not compare the gross benefit with the deposit. He simply adjusts his grocery budget. 3 months later, he discovers that $290 is being taken for Medicare Part B, and another amount is being withheld for federal income tax because he requested withholding during a phone call the year before. His retirement benefit was not reduced. His take-home payment was. That difference may sound small, but it changes the entire solution. Robert does not need to appeal the benefit formula. He needs to decide whether the tax withholding still fits his situation and confirm that the Medicare premium is correct. Now imagine Linda, a retired school employee in Texas. Her situation looks similar but is completely different. Her Social Security amount had once been reduced because of a pension from work that was not covered by Social Security. Then, the Social Security Fairness Act ended the windfall elimination provision and government pension offset for benefits payable from January 2024 forward. Social Security processed millions of adjustments and sent retroactive payments. Linda receives a larger deposit, but she does not know whether it includes the correct monthly increase, a one-time past due amount, or both. If she compares only one bank deposit, she cannot tell. She needs the mailed notice and her benefit details. The same bank account can show a perfectly correct deposit that still makes no sense without the government explanation behind it. This is the first major revelation. The bank deposit is evidence that money arrived. It is not proof that every part of the benefit calculation is correct. Most people never realize this because the deposit feels official. It has a federal description, a date, and an exact amount down to the penny. Precision creates trust, but a precise number can still be based on incomplete earnings, an old tax return, an early claiming reduction, or a deduction you no longer understand. Nobody is going to tell you about this every month. Social Security sends notices when certain things change, but it does not send a personal advisor to your kitchen table to compare your lifetime record, your spouse's record, your Medicare premium, your taxes, and your bank statement. You have to claim what requires an application. You have to challenge what requires an appeal. You have to report what the rules require you to report. And you have to verify what is supposed to happen automatically. The system's greatest advantage is also its greatest weakness for ordinary people. It processes enormous numbers of payments using standardized rules. Standardization allows more than 70 million people to receive benefits, but standardized systems do not know the story in your head. They know what is in the record. They do not know that an employer closed 30 years ago. They do not know that you kept a W-2 in a box in the attic. They do not know that you divorced after 12 years unless the proper information reaches the correct record. They do not know that your income dropped after retirement unless you report the life-changing event through the proper Medicare process. They do not know that an overpayment notice will leave you unable to buy food unless you request a lower recovery rate or a waiver. The machine follows the information it has. That is why the words, "check your benefit amount," mean much more than logging in and seeing one number. You are going to learn how the amount is built, how it can be reduced before it reaches the bank, how working can temporarily hold back benefits, how later earnings can increase a payment, how spouse and survivor rules can create money that is not automatic, how Medicare can use old income and charge today's premium, how taxes can make a raise feel like a cut, and how an overpayment notice can threaten half of a monthly check if it is ignored. Each one of these rules is real. Each one has a different remedy. And the last one I will show you is the quietest of all, because it can remain hidden for years inside a number that looks completely normal. Before I go deeper, I want to slow this down because behind every calculation is a real household. I have seen retired couples sit at a dining room table with a utility bill, a pharmacy receipt, and a bank statement spread between them. They are not trying to become wealthy. They are trying to decide which bill can wait. I have seen veterans who manage dangerous work with discipline become frightened by a government envelope because they do not understand whether it means a reduction, a debt, or a request for information. I have seen widows continue living on the same deposit for months because calling an agency after a spouse's death feels overwhelming. I have seen people who trusted every employer and every bank feel embarrassed when a record turns out to be wrong. There is no shame in this. The rules are complicated, the letters are dense, and fear makes people avoid the very paper that could protect them. A quiet financial loss does not always look like a crisis. Sometimes it looks like buying less meat at the grocery store. It looks like delaying a dental visit. It looks like keeping the thermostat lower. It looks like using a credit card for a car repair because the monthly check is $50 below what it should be. Then the credit card interest turns that $50 monthly problem into a much larger one. This is how a small error in one system can spread through the entire household. The benefit is lower, the card balance rises, the minimum payment increases, and the retiree starts believing that retirement itself was the mistake. But there is a more intelligent way to act. You separate the systems, identify the exact reason for each dollar, and correct the part that can be corrected. The first place to look is the foundation, your earnings record. Social Security retirement benefits are generally based on your highest 35 years of indexed earnings. Indexed simply means that older earnings are adjusted to reflect changes in average wages before the formula is applied. If you have fewer than 35 years of earnings, the missing years do not disappear. They enter the calculation as zeros. Think of 35 boxes lined up on a table. Social Security fills the boxes with your strongest covered earning years. If only 32 boxes contain wages, 3 boxes contain zero. A 0 year can pull down the average just as surely as an empty chair reduces the average amount of food at a table. This is where many people make an invisible mistake. They look at the total number of years they worked, not the number of years that appear correctly in the Social Security record. A woman may say, "I worked for 38 years," and be completely truthful, but perhaps 4 years of part-time work were not reported correctly. Perhaps self-employment income was reported on a tax return, but the Social Security number was wrong. Perhaps a household employer did not properly report wages. Perhaps a business used a married name while Social Security still had a prior name. The person remembers 38 working years. The system may see 34 complete years and 1 0. The formula uses the system's record. Consider a man named James who worked construction from 1988 through 2024. In 2001, a small contractor paid him properly and gave him a W-2, but the company later disappeared. James never checked his Social Security statement. At age 63, he claims benefits because his knees hurt and he cannot keep working. The missing year was not his highest earning year, so correcting it might change the monthly benefit only modestly. But modestly does not mean meaninglessly. An extra $25 a month is $300 a year. Over 15 years before future cost of living adjustments, that is $4,500. If the missing year replaces a 0 or a much lower year, the effect can be larger. The exact amount depends on the formula, but the principle is simple. One missing year can keep costing money every month until it is corrected. Your official Social Security statement shows the earnings posted to your record and estimates of future benefits. People age 60 and older who do not have an online account may receive a paper statement before their birthday, but nobody should depend on memory alone. The online account lets you review the history year by year. Do not stare only at the projected monthly benefit. Move your eyes to the earnings table. Compare each year with old W-2 forms, tax returns, pay records, or other proof. You are not looking for perfect memory. You are looking for impossible gaps. If you know you worked full-time in 1997 and the record shows 0, that is a warning. If the record shows $8,000 and you remember earning $38,000, that deserves attention. Most people think they do not qualify for a correction because the mistake is old. That assumption can be expensive. Social Security has time limits and evidentiary rules for correcting earnings records, but there are also exceptions in certain circumstances, and the agency tells people to contact it when the record is wrong. Do not decide by yourself that an old error is hopeless. Gather what you have. A W-2 is strong evidence. A tax return, pay stubs, an employer statement, union records, or other documents may help. The point is not to argue emotionally that you worked hard. The point is to show the year, the employer, and the amount that should have been credited. Government systems respond to specific facts. Self-employed people face a special danger because Social Security credit depends on properly reported net earnings and self-employment tax. A person can have money flowing through a business account and still show little covered income if business income was not reported correctly. Some owners try to reduce taxes aggressively during working years, then discover at retirement that the Social Security formula remembers the lower reported earnings. This is not a punishment added later. It is the other side of the same tax return. Lower covered earnings can mean lower benefits. A person cannot tell Social Security at age 67 that the business was successful while years of filed returns showed very little net income. The benefit formula uses what was reported under the law. The IRS and Social Security are different agencies, but the information on tax and wage forms can feed the earnings record. That is one reason a small identification error matters. One wrong digit, a name mismatch, or a late corrected wage report can create a record problem. Modern systems perform massive information matching. They do not need to dislike you. They only need two pieces of data that do not line up. Artificial intelligence may help institutions detect patterns and fraud, but the core danger for a retiree is much simpler. Computers are literal. A person sees John A. Smith and John Allen Smith and knows they may be the same man. A system waits for identifying information to match. Here is the practical protection. Once a year, choose a quiet morning and compare the earnings record with the documents you still have. Do it before claiming if possible, because problems are easier to address when there is time. But if you already receive benefits, do not assume it is too late to look. Your benefit can be recomputed when qualifying earnings are added or corrected. This is not automatic in the sense that a missing record will somehow understand itself. The annual review of properly reported new earnings may be automatic. The discovery of an old missing year often begins because you noticed it. There is another part of the earnings rule that comfortable middle-class retirees frequently miss. Continuing to work after claiming can sometimes increase the monthly benefit. Each year, Social Security reviews the record of a working beneficiary. If the new year of earnings is among the highest 35 years, the agency can recalculate the benefit and pay an increase retroactive to January following the year of earnings. Imagine Susan claimed at 66 and continued earning $58,000 a year for 2 more years. One of those new years replaces a year from early in her career when she earned the inflation-adjusted equivalent of much less. Her monthly benefit may rise. She may see a later adjustment and think it is a random correction. It may be the formula replacing a weaker year with a stronger one. But watch how this works. New earnings can increase the underlying benefit while the retirement earnings test can temporarily withhold payments if the person is under full retirement age. These are two separate mechanisms operating at the same time. One asks whether a new year improves the 35-year average. The other asks whether current earnings exceed the annual limit before full retirement age. People confuse the two and believe that working always hurts Social Security. It does not. Working can cause temporary withholding under one rule and a future increase under another. At full retirement age, Social Security recalculates to give credit for months in which benefits were withheld because of earnings. The withheld money is not treated exactly like money sitting in a personal savings account waiting to be returned in one check. Instead, the monthly amount is adjusted through the formula. In 2026, a person under full retirement age for the entire year can earn up to $24,180 before the earnings test begins withholding benefits. Above that amount, $1 in benefits is withheld for every $2 of earnings. In the year a person reaches full retirement age, the higher limit is $65,160 for earnings before the month full retirement age is reached, and $1 is withheld for every $3 over that limit. Beginning with the month the person reaches full retirement age, the earnings test no longer applies. These are not tax limits. They do not mean you are forbidden to work. They are benefit withholding rules. Take Michael, age 64, receiving $2,000 a month or $24,000 a year. He earns $44,480 from a job in 2026. That is $20,000 above the $24,480 limit. Under the basic calculation, Social Security may need to withhold $10,000 of benefits because the rule is $1 withheld for every $2 above the limit. Michael may receive no payment for several months while Social Security satisfies the required withholding. If he expected every monthly deposit, his checking account can suddenly become dangerous. The benefit was not permanently erased, but the cash flow interruption is real. A mortgage company does not care that the formula may adjust later. It wants the payment this month. This helps both lower-income retirees and comfortable middle-class retirees because the danger is not limited to people with small checks. A person receiving $200 can be harmed by one withheld month. A person receiving $3,500 can build a lifestyle around the full deposit and be harmed by several withheld months. The system does not measure emotional dependence on the payment. It applies the arithmetic. That is why income estimates must be accurate and changes should be reported. If you expect to earn less than originally reported, update the estimate. If you expect to earn more, prepare for withholding. The worst plan is surprise. If this information is helping you understand your own benefits so far, leave a like. It tells me that clear, protective explanations like this are worth continuing. Now notice what the first cycle has revealed. The monthly payment can be wrong because an earnings year is missing. It can change because a new high-earning year was added. It can be temporarily withheld because current work exceeded a limit. All three events involve earnings, yet each follows a different rule. This is why calling Social Security and saying only, "My check is wrong," often leads to confusion. You need to say what you found. My 2001 earnings are missing. I worked in 2025 and believe it replaced a lower year. My 2026 earnings estimate changed. Specific language moves the conversation from fear to a correct process. But earnings are only the first layer. The next layer can lock in a difference for the rest of your life. And it begins with the month you choose to claim. The month you start Social Security is not a clerical detail. It can permanently shape the base amount you receive. For people born in 1960 or later, full retirement age is 67. A person can generally start retirement benefits as early as 62, but starting early reduces the monthly amount. Waiting beyond full retirement age can add delayed retirement credits until age 70. For people born in 1943 or later, those credits are generally 8% for each full year of delay after full retirement age, applied month by month. At age 70, the increase stops. There is no extra reward for waiting until 71 or 72. Think of the full retirement benefit as a loaf of bread. Claiming early does not mean the government gives you the same loaf sooner. It means the loaf is sliced into a permanently smaller monthly portion because payments are expected to last longer. Delaying beyond full retirement age makes each future monthly slice larger because you gave up earlier payments. Neither choice is automatically right for everyone. Health, work, savings, family longevity, debt, and a spouse's future survivor benefit all matter. But claiming without understanding the permanent monthly difference is one of the most expensive invisible decisions in retirement. The 2026 maximum examples show how strongly age can matter for someone who earned the maximum taxable amount for many years. The maximum retirement benefit for a worker starting at full retirement age in 2026 is $4,150 a month. For a worker starting at age 62 in 2026, the maximum example is $2,169. For someone starting at age 70 in 2026, it is $5,181. Very few people receive those maximums because they require decades of very high covered earnings, but the comparison teaches the rule. The claiming month can create a difference of more than $2,000 a month at the top end. For an ordinary worker, the dollar difference is smaller, but the percentage effect still matters. Now picture Carol, age 62, who lost her job and claimed because she needed income. Her full retirement age estimate was $2,100, but her early amount is around $1,470 before later cost of living increases, depending on the exact number of months early. She tells her sister, "Social Security took more than $600 from me." That description captures how it feels. But technically, the early claiming formula reduced the amount because Carol chose to begin years before full retirement age. If nobody explained the decision clearly, Carol may feel cheated. Yet the remedy is not a simple appeal claiming that $2,100 was promised. The statement showed an estimate at a different claiming age. This is where many people misread their statement. They see several estimated amounts but remember only the largest one. The estimate at age 70 is not a promise that applies at 62. The full retirement amount is not the same as the early amount. The estimate may also assume future earnings at a stated level. If you stop working earlier than the estimate assumed, the actual calculation may be lower. Here's what almost nobody understands. The statement is a planning document based on recorded earnings and assumptions. The award notice after you claim is the official explanation of the benefit granted. You must compare the age, the earnings assumption, and the type of benefit. Comparing only the biggest number with the bank deposit creates false alarm. But there are real reasons to question a claiming age calculation. The birth date could be wrong. The month of entitlement could be different from what you requested. A person may have withdrawn an application, suspended benefits after full retirement age, or switched from survivor benefits to retirement benefits, creating a more complicated record. A worker may have been told that retroactive benefits were available after full retirement age, without understanding that taking retroactive months can reduce delayed credits. The system works by months, not by the general feeling that you waited about 2 years. Suppose David reaches full retirement age in June and waits until age 69 to apply. In some situations, he can request up to 6 months of retroactive retirement benefits, but taking those months means his official start date moves backward and he gives up delayed retirement credits for those months. A 6-month lump sum may look attractive. If his monthly full retirement benefit were $2,800, 6 months could mean roughly $1,608 before deductions, but the future monthly benefit would be lower than if he kept the later start date. A one-time deposit can hide a lifelong trade-off. Nobody is going to tell you about this at breakfast. You have to ask what start month the application uses and what that choice does to the monthly amount. There is also a protective rule people overlook after full retirement age. A person already receiving retirement benefits may voluntarily suspend them up to age 70 to earn delayed retirement credits for future months. But family benefits paid on that person's record may also be affected, and Medicare premiums still need to be paid. This is not a decision to make from a short internet video. It requires personal analysis. I am explaining the mechanism so you know that a benefit amount can change because of a deliberate suspension, not because money vanished. Now we reach Medicare, the place where a Social Security raise can appear to shrink before it reaches the bank. Medicare Part B premiums are commonly taken directly from Social Security payments. In 2026, the standard Part B premium is $202.90 a month, up from $185 in 2025. The annual Part B deductible is $283. If a retiree's gross Social Security benefit rose by $56 because of the 2.8% cost of living adjustment, but the standard Part B premium rose by $17.90, the net increase available in the bank could be closer to $38 before any other changes. The Social Security benefit increased. The Medicare deduction also increased. Both statements can be true. Imagine Helen's gross benefit was $2,000 before the 2026 adjustment. A 2.8% increase would add about $56, making the gross benefit roughly $2,056, subject to Social Security's rounding rules and her actual record. If her Part B premium rises by $17.90, much of the increase remains, but not all of it reaches her checking account. If she also has federal tax withholding, a Part D premium, or an income-related surcharge, the bank deposit may change by even less. Helen hears on television that retirees received a 2.8% raise and believes her bank should show exactly 2.8% more. That is the wrong comparison. She must compare gross benefit with gross benefit, then deduction with deduction, then deposit with deposit. For higher-income Medicare beneficiaries, the difference can be far larger because of the income-related monthly adjustment amount, often called IRMAA. For 2026, the standard Part B premium applies when modified adjusted gross income is $109,000 or less for an individual filer or $218,000 or less for a married couple filing jointly. Above those thresholds, Part B premiums rise in steps. An individual with 2024 income above $109,000 and up to $137,000 can pay $284 a month for Part B in 2026. At higher income levels, the Part B premium can rise to $405.80, $527.50, $649.20, or even $689.90 a month. Part D can have an additional income-related amount as well. Most people think they do not qualify for relief because the IRS number was once correct, but Medicare usually looks back to the tax return from 2 years earlier. For 2026 premiums, that generally means tax year 2024 income. A person may have earned $180,000 in 2024, retired in 2025, and live on $55,000 in 2026. The system sees the older high-income year unless the retiree reports a qualifying life-changing event. Retirement or a reduction in work can qualify. Form SSA 44 is used to request a new decision based on a life-changing event and lower expected income. This is not automatic. You have to claim it. Watch how this works in real life. Thomas and Maria filed jointly with modified adjusted gross income of $260,000 in 2024 because Thomas received a final bonus and sold company stock. By 2026, both are retired, and their expected income is $120,000. If they do nothing, the old return can place them above the $218,000 joint threshold for 2026 and increase Medicare premiums. They may look at smaller Social Security deposits and assume Social Security cut their benefits. The benefit itself may be unchanged. The Medicare surcharge is the cause. By reporting retirement and providing the required evidence, they may obtain a new IRMIA determination based on lower income. The money at stake can be hundreds of dollars a month for a couple. This helps both lower-income retirees and comfortable middle-class retirees. Lower-income retirees need to confirm whether they qualify for programs that help pay Medicare costs or prescription expenses. Comfortable middle-class retirees need to watch income cliffs that can trigger higher Medicare premiums. The same principle protects both groups. Do not assume the amount is automatic. Benefits, subsidies, and premium reductions often require an application or a reported event. A large 401k withdrawal can also change this picture. Your 401k balance does not directly reduce your Social Security retirement benefit. A Roth IRA distribution that meets the tax rules generally does not enter income the same way a taxable traditional retirement account withdrawal does. But taxable income can affect whether Social Security benefits are taxed and whether future Medicare premiums rise. That is why a one-time withdrawal to buy a car, pay off a mortgage, or help an adult child can echo into a Medicare premium 2 years later. The bank simply shows money arriving from the retirement account. The IRS sees taxable income. Social Security later receives income information used for Medicare. The retiree experiences the final result as a smaller monthly deposit and may never connect it to the withdrawal made 24 months earlier. Consider Frank, who withdraws $90,000 from a traditional IRA to renovate his home. He believes there is no loan, no interest, and therefore no financial danger, but the withdrawal adds taxable income. Depending on his other income and filing status, it can make more of his Social Security taxable and may push his modified adjusted gross income above an IRMA threshold for a future year. The renovation cost is not merely $90,000. It may include income tax and higher Medicare premiums later. This does not mean he should never use retirement money. It means he should calculate the full cost before the money leaves the account. A qualified Roth IRA can provide different tax treatment, but Roth conversions can create taxable income in the year of conversion. A conversion may be wise in a long-term plan, yet it can still affect Medicare premiums later. This is where generic advice becomes dangerous. Someone says, convert everything before tax rates rise, without asking whether the conversion will cross an IRMA line. Another person says, never convert, without considering future required distributions or a surviving spouse filing as a single taxpayer. There is no universal answer. There is only a need to understand how one decision changes several systems. Inheritance creates another area of confusion. Receiving inherited property does not automatically mean your Social Security retirement benefit is reduced. Social Security retirement is not a means-tested benefit like supplemental security income. Your credit score, home value, savings account, and ordinary inheritance do not directly set the retirement benefit earned from work. But inherited traditional retirement accounts can create taxable distributions. Selling inherited investments can create taxable gains. Interest and dividends can increase income. Estate taxes generally apply at the estate level under federal rules and affect only very large estates, while some states have separate estate or inheritance taxes. The important point is not to fear an inheritance. It is to understand that the income produced or distributed after the inheritance can affect taxes and Medicare even when the Social Security formula itself does not change. This changes everything because it teaches you to stop using the word check as though it were one indivisible object. The gross Social Security amount comes from one set of rules. Medicare deductions come from another. Tax withholding comes from another. Retirement account withdrawals can influence future taxes and Medicare. Bank fees and automatic payments affect what remains after deposit. When you separate the layers, the system becomes less frightening. But there is another layer that many married, divorced, and widowed Americans never examine at all. It is the possibility that the correct amount is not based only on their own work record. A Social Security retirement payment can be based on your own work, your current spouse's record, a former spouse's record, or a deceased spouse's record, depending on the facts. This is where most people think they don't qualify, becomes especially dangerous. A spouse's benefit can be worth up to one-half of the worker's full retirement amount when claimed at the spouse's full retirement age. A surviving spouse's benefit can be worth up to 100% of the deceased worker's amount when claimed at the survivor's full retirement age, although claiming earlier can reduce it. A divorced person may qualify on a former spouse's record when the marriage lasted at least 10 years and other conditions are met. These benefits are not simply added on top of everything else. Social Security generally pays your own benefit first and then adds enough from the other record to bring you to the higher eligible amount. Picture Diane, age 67, receiving $1,050 on her own work record. Her husband's full retirement amount is $2,800. At her full retirement age, a full spouse's amount could be as high as $1,400. Social Security would not normally pay $1,050 plus another $1,400. It could pay her own $1,050 and a spouse's addition of about $350, bringing the total to approximately $1,400, assuming all requirements are met. Diane may say, "I do not qualify because I already have my own Social Security." That is wrong. Having your own benefit does not automatically eliminate the possibility of a spouse's addition. The comparison matters. Now imagine Evelyn, whose former husband earned much more than she did. They were married for 14 years and have been divorced for 12. Evelyn never remarried. She assumes that asking about his record would take money from him or reveal her finances to his new wife. A divorced spouse's benefit generally does not reduce the worker's payment or the payment to a current spouse, yet Evelyn may go years without asking because the emotional discomfort of the divorce hides the financial rule. Nobody is going to tell you about this at the grocery store. You have to claim it. Survivor benefits require even more care because the timing choices can be different from ordinary retirement benefits. A widow or widower may sometimes start one type of benefit and later switch to another, depending on eligibility and amounts. A survivor might take a reduced survivor benefit earlier and allow their own retirement benefit to grow until age 70. Another person may be better served by taking their own benefit first and switching to a larger survivor amount later. The correct path depends on age, earnings history, health, and the exact records. This is not automatic, and the survivor application is not handled exactly like every online retirement claim. A grieving person who assumes the higher amount will simply appear can lose months of valuable planning. When one spouse dies, household Social Security income often falls sharply, even when the survivor receives the larger of the two individual payments. A couple receiving $2,600 and $2,500 may have $4,100 coming into the household. After one spouse dies, the survivor does not usually continue receiving both full checks. The survivor may move to the higher eligible amount, perhaps around $2,600, but household income still drops by $1,500, while many costs remain. Property taxes do not fall in half. The roof does not become half as old. Insurance, utilities, and home repairs continue. That is why the higher earner's claiming decision can be a survivor protection decision, not merely a personal break-even calculation. Tell me in the comments, did you already know this rule about spouse and survivor benefits, or are you hearing about it for the first time? Names, dates of marriage, dates of divorce, death certificates, and Social Security numbers connect one person's record to another. If a prior marriage is missing from the conversation, the agency cannot evaluate what nobody mentioned. Do not assume that a representative will discover every possible benefit without complete information. State the marital history clearly and ask which records were compared. The Social Security Fairness Act created one of the largest recent examples of benefit amounts changing because an old rule was removed. Signed on January 5, 2025, it ended the windfall elimination provision and government pension offset for benefits payable from January 2024 forward. Those old provisions had reduced or eliminated benefits for certain people who received pensions from work not covered by Social Security, including some teachers, firefighters, police officers, federal workers under the older civil service retirement system, and people with certain foreign pensions. Social Security reported completing more than 3.1 million payments totaling about $17 billion by July 2025, and some monthly increases exceeded $1,000 depending on the individual case. But not every public worker received an increase. Most state and local public employees already worked in jobs covered by Social Security and were not affected by those provisions. This is why headlines can mislead. A retired teacher may hear, "Teachers are getting more," and assume a payment is missing. Another retired teacher may assume the change does not apply and fail to check a real increase. The pension source, the Social Security coverage of the job, the type of benefit, and the old reduction all matter. For people affected, the adjustment process included new monthly amounts and retroactive money going back to January 2024. A bank deposit could arrive before the explanatory notice. Some people received more than one notice. That creates the perfect environment for confusion and scams. A legitimate retroactive payment does not require paying a stranger a fee, buying gift cards, moving money to a safe account, or giving a caller a one-time banking code. Social Security already had the authority to process the adjustment. A person who receives an unexpected federal deposit should verify it through the official account or official phone number, not through a link in a text message. This is where banking rules and fraud monitoring enter the story. Banks are required to watch for unusual activity and follow anti-money laundering rules. A sudden large government deposit, followed by immediate wires to unfamiliar recipients, can look different from a retiree's normal pattern. The bank's security system may delay a transfer, ask questions, or block a suspicious transaction. That can feel like the bank is controlling your money, but sometimes the interruption is designed to stop fraud. At the same time, criminals know that retirees receive predictable federal deposits. They impersonate agencies, manipulate caller identification, and create urgent stories. The protective habit is simple. Never let an incoming call control the next movement of your money. Now we need to talk about taxes, because a benefit amount can be correct and still produce an unexpected tax bill. Social Security benefits are not automatically tax-free. Federal law uses what is often called combined income, adjusted gross income, tax-exempt interest, and one-half of Social Security benefits. For an individual, combined income between $25,000 and $34,000 can make up to 50% of benefits taxable, and above $34,000 up to 85% can be taxable. For married couples filing jointly, the comparable ranges are $32,000 to $44,000 and above $44,000. Up to 85% taxable does not mean an 85% tax rate. It means up to 85% of the benefit can be included in taxable income and then taxed at the person's applicable rate. In 2026, seniors are also dealing with a newer federal deduction. For tax years 2025 through 2028, eligible taxpayers age 65 or older may claim an additional deduction of up to $6,000 per person, or $12,000 for a married couple when both qualify. The deduction phases out above modified adjusted gross income of $75,000 for an individual or $150,000 for joint filers. This can reduce taxable income, but it did not rewrite the Social Security benefit formula, and it did not make every person's Social Security automatically tax-free. Most people think a political slogan changes the monthly deposit immediately. It usually does not. Tax relief may appear when the return is filed or withholding is adjusted. Social Security allows voluntary federal tax withholding from monthly benefits at set percentages. A person can choose 7, 10, 12, or 22%. If withholding is too low, the retiree can owe money at tax time. If it is too high, the bank deposit is smaller all year, and the retiree may receive a refund later. Neither situation proves the underlying benefit is wrong. The withholding election is the cause. Compare Form SSA 1099, the tax return, and the monthly benefit details. If you receive a pension, wages, interest, taxable IRA distributions, or investment income, the tax result can change even when Social Security stays the same. This is also why taking money from a 401k in December can have consequences that appear far from December. The withdrawal can increase taxable income for that year. It can cause more Social Security to be included in taxable income. 2 years later, it can affect Medicare premiums. Then the retiree sees a smaller net payment and believes a new Social Security rule caused it. The real cause began with a retirement account decision. The system is a chain. One action touches taxes, Taxes touch Medicare. Medicare touches the Social Security deposit. If you want to keep receiving explanations like this, consider subscribing to the channel and turning on notifications so you do not miss the next videos. Now we arrive at the most dangerous cycle: overpayments. An overpayment happens when Social Security says it paid more than the person should have received. The cause can be unreported work, a change in marital status, a return to work while receiving disability benefits, incorrect income information, a duplicate payment, or an agency error. The notice may demand thousands of dollars. A retiree sees the word overpayment, feels accused, and either pays immediately without checking or hides the letter in a drawer. Both reactions can be costly. Current Social Security guidance says that for many new Social Security overpayments, if the person does not repay, appeal, request a waiver, or arrange a lower rate, the agency can withhold 50% of the monthly Social Security benefit. Supplemental security income generally uses a different 10% recovery rule. Think about the impact of this. A retiree receiving $1,800 could suddenly lose $900 a month during collection. That is not a small adjustment. It can break a household budget. But the notice is not the end of the process. If you believe the overpayment decision or amount is wrong, you can request reconsideration. If the overpayment was not your fault and repayment would be unfair or create hardship under the rules, you can request a waiver using Form SSA 632. If you accept that money is owed but cannot afford the proposed withholding, Form SSA 634 can request a different recovery rate. Filing promptly matters because collection can be paused while certain timely requests are decided. This is not automatic. You have to claim the protection. Imagine Arthur, a 72-year-old veteran who receives $2,050 a month. Social Security sends a notice claiming a $9,600 overpayment from a period when he worked part-time. Arthur knows he reported the job by phone but has no confirmation number. He panics and pays $2,000 from savings, then agrees to a large monthly withholding. Later, his daughter finds pay records showing that the earnings were lower than the amount Social Security used. If Arthur had requested reconsideration and provided the evidence first, the debt might have been reduced or removed. Paying quickly did not prove the notice was correct. It only moved money. Now picture Brenda, who was genuinely overpaid because a change was reported late. She does not dispute the amount, but 50% withholding would leave her unable to pay rent and medicine. She assumes the rate cannot be changed. That is false. She can ask for a lower recovery amount and may need to show income, assets, and necessary living expenses. The system will not know that the refrigerator is empty unless the hardship is documented through the proper process. This is the hidden rule that costs people the most. Silence is treated as acceptance by many administrative systems. The computer sends a notice. A deadline passes. Collection begins. The system does not interpret silence as fear, illness, grief, confusion, or difficulty reading English. It interprets silence according to procedure. That is why every Social Security notice should be opened, dated, and matched to the payment it describes. You do not need to understand every sentence on the first reading. You need to identify the amount, the reason, the effective date, the deadline, and the appeal or review rights. The climax of this entire problem is not that Social Security is secretly choosing random numbers. The real danger is more ordinary and more powerful. A lifetime benefit is assembled by separate gears. One gear holds 35 years of earnings. Another holds the claiming month. Another applies cost of living increases. Another compares current work with the earnings limit. Another checks spouse or survivor eligibility. Another pulls Medicare premiums from tax return income. Another withholds taxes. Another collects an overpayment. Another sends the remaining money through Treasury to a bank. Each gear can be operating under its own rule, on its own schedule, using information from a different year. Picture those gears turning in a dark room. The earnings record turns slowly over decades. The claiming age gear locks into place when benefits begin. The Medicare gear reaches backward 2 years to an old tax return. The tax gear reacts to pensions, interest, and retirement account withdrawals. The overpayment gear waits for a notice deadline. The bank gear sees only the final electronic instruction. By the time the money appears in your checking account, all those earlier decisions have been compressed into one number. That number looks simple because the complexity has already happened. The strongest protection is a personal benefit audit. Start with the official benefit verification letter and identify the gross monthly amount. Compare it with the latest cost of living notice. Then identify every deduction: Medicare Part B, any Part D amount, any income-related Medicare surcharge, federal tax withholding, and any overpayment recovery. Compare the remaining amount with the bank deposit. Then move backward to the earnings record and scan every year for zeros or amounts that do not make sense. Confirm the age and month used when benefits began. Ask whether continuing work created a new high-earning year. Review marital history and determine whether a spouse, divorced spouse, or survivor comparison was made. If you have a public pension from work not covered by Social Security, confirm whether the removal of WEP or GPO changed the record. If income fell after retirement and Medicare is using an older high-income year, examine Form SSA 44. If an overpayment exists, read the appeal, waiver, and lower repayment options before the deadline. I describe that as one flowing process because these items belong together. You are not creating a fight with the government. You are reconciling records, the same way a careful business owner reconciles a bank account. Most people never realize this, but agencies make decisions from documents, and you can also use documents. A bank statement proves what arrived. A benefit letter proves what was authorized. A Medicare notice explains a premium. A W-2 supports earnings. A marriage certificate, divorce decree, or death certificate supports family benefit facts. A tax return shows the income used for Medicare. A retirement letter can support a life-changing event. Paper turns a vague complaint into a solvable question. Keep copies of everything you submit. Write down the date, time, and purpose of every call. Save confirmation numbers. When possible, use the official online account reached by typing the government address yourself, not by clicking a message. Do not give your Social Security number, bank password, or one-time security code to an unexpected caller. Social Security may contact people for legitimate reasons, but urgency, threats, secrecy, gift cards, cryptocurrency, or demands to move money are signs to stop. This content is educational. It does not replace personalized financial, legal, tax, or accounting advice. A claiming decision can affect a spouse for decades. A tax move can affect Medicare later. An appeal can depend on facts and deadlines. When the amount is meaningful or the record is complicated, use a qualified professional who will review documents rather than sell fear. I want to speak directly to the person who has been afraid to look. You are not too old to understand this. You are not foolish because a government letter confused you. You are not ungrateful because you question a number. You worked for the record behind that payment. Checking it is not greed. It is stewardship. It is protecting the mortgage-free home, the emergency savings, the small inheritance for your children, and the quiet retirement you spent decades building. Do not end this video with panic. End it with a date on your calendar. Choose one day this week to open your Social Security account or request the official benefit information. Compare the gross amount with the deposit. Find the deductions. Review the earnings history. If something is unclear, ask a precise question. Why is my Medicare premium $405.80 instead of $202.90? Why does 1999 show zero earnings? Was my spouse's record compared with mine? Did my 2025 earnings create a recalculation? What month did my benefit officially begin? What is the deadline to appeal this overpayment? Precision protects you. Share this video with a spouse, a brother, a sister, a parent, a veteran, a retired teacher, or a friend who lives on Social Security. You may be sending them the explanation that prevents years of quiet loss. And if you think this is important, watch the next video appearing on the screen. In it, I explain another financial situation that can directly affect the money of millions of retirees and that almost nobody is watching carefully enough. The system is complicated, but you are not powerless. When you understand the gears, you can protect the amount you earned and the peace you deserve.